Hey guys, I just wanted to make this quick video because I found this thing really annoying. So I was reading this article here that you see up on the screen at Wolf Street, talking about the Fed's QE Unwind reaches $285 billion. And you're seeing a lot more of this in the financial news right now because, well, the bonds and mortgage-backed securities that the Federal Reserve is holding are, starting to roll over and let expire off the balance sheet. That is the QE Unwind. So they're not cashing in the bonds that they're holding, but when they come up to be expired, they just don't renew that money and don't roll it over to the next expiration period. So far, so good, right? So as a result, we can see that the unwind has reached $285 billion here, and we have seen interest rates go up pretty significantly over the last however many months it's been. And, this author's point, Wolf Richter, is pointing out that the way the language is constructed is that they're letting up to so many $billion unwind each month, and that this was the first time that actually mattered. So, and I think he was saying October will be when they hit that number because of the biweekly roll-off kind of thing. But this whole thing just strikes me as missing the point, because yes, so we're back to March 5th, 2014 levels on the Federal Reserve's balance sheet at 4.175 billion or trillion rather dollars on the balance sheet. And I mean, that's all true as far as it goes. But March 5th, 2014 was well into the QE period. So what I did is I went to the St. Louis Fed and their Fred graphing system, and yes, we are here, right? And yes, if we go back to March of 2014, then we reach that same type of number. But let's go back to the beginning of the financial crisis. So we're down here at, let's be generous, call it $1 trillion. Okay, so right now we're at 4.1 trillion, and to get back to the beginning of QE and unwinding the whole stimulus package, we got to go all the way down to 1 trillion. And I mean, from the reaction that we're seeing in the market, that this $285 billion roll-off has caused interest rates to go up, and we're starting to see articles in the financial press about junk bonds, yields going up, which means the prices are going down, and that bubble starting to pop. I've seen that language once or twice, and we're starting to see real estate mortgage applications, either roll over or decrease. So even the small change that we are seeing is already having significant effects in the financial markets. So the chances that we could take 4 trillion down to 1 trillion without completely crashing the economy is slim to none, basically. And we've seen statements from the Fed Chair Powell about how we still got a lot of upside in interest rates to reach the so-called neutral rate. And yeah, I don't really see that happening. As soon as those rates start to climb a little bit, towards that neutral rate, then I think that will precipitate the next crash. And I've said I don't think we're getting out of 2019 without a crash. Because either this process that we're looking at right here continues and rates go up, or the Fed has to end up backtracking, reducing rates, and basically admitting defeat to the world, in which case that could precipitate a crash. So that's the way I see it anyway, and let me know what you think.